Good afternoon, everyone. My name is Duncan Lamb, and on behalf of Colliers International, I'd like to welcome you to this Midsummer Retail Market Update. Many of you will be familiar with the annual Midsummer Retail Report, but for obvious reasons, we're taking a different approach to putting the market into context this year. We're actually going to hold two Midsummer webinars this year. Today's will get views from a panel of experts on where we currently are in the sector and what may lie ahead. And then in the autumn, we'll be holding a second webinar for which we'll draw on data and research regarding what has been happening since UK shops started reopening this week. We have an excellent panel today, which comprises leading figures from the sector and also agency experts from Colliers. I'll be talking to each of them presently, and after that we'll have a general discussion. Do feel free to use the Q&A button in front of you to submit your questions. But I have to say that we do have about 600 and rising people on the webinar already. So I'll try and raise your issues, but I may not be able to get through all of them. Now I'd like to hand over to Matthew Thompson, who's Head of Retail Strategy at Colliers. About a month after lockdown, Matt carried out a survey of retail landlords to gauge their response to the situation. He's now going to take us through those findings and also touch on a potential new model for retail property leasing. Matt.
Thanks, Duncan. Good afternoon, everyone. As Duncan says, in the week commencing April 20th, we surveyed a group of property owners who control more than 120 million square feet of retailing and F&B space across the country. We asked them a series of questions on how they adapted to the trading conditions of the lockdown and how their strategy had changed in the face of the pandemic. Broadly, the survey covered three areas, centering around current rental strategy, sentiment on future outlook, and the future leasing model. The results themselves were compelling and indicate that we're at a watershed moment for retail property in the UK. Of the owners we surveyed, 79% believe that the pandemic will bring permanent changes to how retail property is leased and on the terms on which it's occupied. A hugely significant figure which could mark the beginning of a new type of relationship between owners and their occupiers. The challenge for now is for both sides of the equation is to respond in a way that can sustain a contractual relationship which is viable for all parties. In the short term, looking at March quarter rents, the majority of owners adopted a case-by-case approach to rental concessions. Of the landlords we surveyed, 71% based their concessions on the nature of the occupier's businesses, 58% considered an occupier's previous rental payment history, and 57% looked at occupier profitability and their ability to pay. So quite clearly, the solution to date has been to categorise occupiers based on their cash flow and their ability to pay. A high number of owners in the survey also referenced the approach of an occupier towards the discussion on rent. This also had an influence over the outcome, indicating that the existing relationship between landlord and occupier remains highly influential. Of course, it will be interesting to see how these approaches change following June rent quarter day, but nevertheless, this is all short term and merely sticking a plaster on it. However, the long term requires a fundamental rethink of the leasing model itself to reflect the huge opportunities that stores still bring today, but also reflect the risks such as this global pandemic. Looking ahead, owners will remain under pressure to deliver high quality, high quantity footfall and prominence for their occupiers. But crucially, they must be able to prove that their strategies are delivering. If stores are to be accurately valued on the basis of their usability for occupiers, then extensive use of high frequency, high granularity data is needed. This space is rich with options today, and technologies and data sets are far more sophisticated now and more accurate than ever before. So without any doubt, now is the time to discuss a data-driven approach to leasing. And to that end, our survey showed that over 40% of landlords are now likely to consider the inclusion of trading and footfall performance data in the calculation of a rent payable for an occupier. We can expect this figure to grow over time, but there are two primary hurdles standing in the way of progress towards a new approach: data access and transparency. 2/3 of owners we surveyed do not have access to the right data sets to measure who is visiting their assets, where they travel from, and the nature of their engagement. Furthermore, even with the right data in place, close to 40% of landlords are still not prepared to share these insights with occupiers, and that's even in return for sales data. With these situations resolved, not only will we have a complete picture of actually how consumers are engaging with our physical retail spaces, but we will have the right ingredients for a fresh approach to leasing, which is crucial if we are to see our retail locations thrive again in the long term. Thank you for your attention. I'll be taking questions throughout the session and happy to pick up offline after the webinar.
Thanks very much, Matt. I can see that we're already getting questions about turnover data, particularly, and how that can feed into the leasing process. So we'll return to that subject in the discussion later. We're now going to get a perspective on the UK retail leasing landscape from Dan Sims. Dan is co-head of the UK retail agency team at Colliers and has oversight across the country's markets. Dan, afternoon. The UK retail agency team has insights into a huge range of shopping environments. As the shops reopen and people can see some sort of return to normality, what level of activity is there in the leasing market?
Yes, hello, Duncan. Just winding that back very slightly and quickly, of course, when the lockdown happened, this was, of course, an enormous shock for everyone and for the market overall. Store turnover fundamentally drives the whole retail property model. And if there's no store turnover, you've got a massive problem. And it was a new shock and it was a new situation for all of us, landlords, occupiers, and advisors as well. So we've taken a lot of time between us all to work out initially. That initial focus was on what on earth would we do about March quarter rents. That focus has moved a little bit to thinking about June quarter rents. But very quickly, the focus for most people has moved on to, as well as solving rents due, how do we position the market for the rest of this year and arguably next year during a recovery? So that is the focus of much of the discussion that me and our team are having at the moment. And in amongst all of that, leasing activity didn't stop. It most definitely slowed down. It slowed down for very obvious reasons, but it was definitely still there. A good example of it was we launched the disposal of 300 of the Carphone Warehouse stores at the end of March. Interesting timing to launch it, but that's what we did. And actually, we've made some pretty good progress on that. And throughout the period of lockdown, and we've made some very good progress on deals. So that's an interesting sort of bellwether for, are there people in the market looking at new store openings later this year? And there are, but it is still, there's absolutely no doubt we're in a very challenging environment now, and plenty of focus of retailers is going to be on getting their existing store portfolio onto the right basis for the rest of this year.
And obviously, unfortunately, we're seeing a renewed flow of CVAs. Like others in the sector, you've in the past been strong in your criticism of how CVAs have been used. I mean, in the current situation, do you think they'll actually help move the market forward, or will they simply forestall the inevitable for some retailers and delay the process of stabilising the market?
Yes, you're right. Of course, there is a renewed focus back on restructuring overall. I think we felt when we went into lockdown that CVAs may not be the solution coming out of the other end of this, and we didn't think that a lot of people would choose the CVA as their restructuring tool. It has been used by some people. Obviously, we've seen Restaurant Group, Pound Stretcher, and perhaps All Saints and others launching CVAs. We're pretty sceptical about the long-term impact of them. The research we did up to last year showed that under 20% of CVAs ever survived long term without another round and bout of restructuring. And I suspect those stats will continue from this round. But most interestingly, what we're seeing is many retailers are skipping straight past CVAs and going for administrations through to pre-packs, a much more extensive version of restructuring, which in effect presses the reset button. And we're not surprised that's happening, and we think there's going to be plenty more of that over the next few weeks, pre-pack being the chosen tool.
Okay, and I mean, I think we all know about the structural difficulties and the disruption of the market, but what needs to be done to try and remedy some of the massive challenges that the sector's facing?
Yeah, I think three sort of key headlines for me. Number one, we all need to continue working on what many of us have been working on for the last couple of years, reducing supply in the market. We've got too much retail space. That equation has got even more acute over recent months. So the market move to repurpose and remove stock absolutely must continue. Second to that is we need to move progressively towards a reduced cost model in UK retail property. And that's not just in terms of rents, it's in terms of business rate impact, how service charges are run, and also how retailers fit out and spend capital on their stores as well. The UK market, I don't think, sustains in most instances very high capital expenditure on stores. So I think we need to take the sting out of the model altogether. And I think underpinning that, we need to move even faster towards more flexible leasing models. And I sense we're going to talk about that a lot later on, but that's going to be a key part of what we're doing for the next few months.
Thanks, Dan. Excellent. We're now going to get the occupiers' perspective, and we have with us today Nigel Duxbury, who is property director for Superdrug at AS Watson, as well as their other health, beauty and phone brands, which together I think comprise around 1,800 stores in the UK. Nigel, good afternoon.
Yes, good afternoon, Duncan.
Good afternoon. Obviously, you've had a slightly atypical experience because Superdrug was at the outset of lockdown classed as an essential retailer. So lockdown's had a different dynamic for this part of the business. Please, can you just talk us through how Superdrug has fared over the last 3+ months and how your strategy has evolved and indeed is evolving as we go into the reopening phase?
Yes, with pleasure. I think it's fair to say it has been a very challenging period. And like all essential retailers, flexibility and strong communication has been absolutely critical. In terms of the first phase, immediately post-lockdown, the key was to deliver confidence to all our store colleagues that it was safe to return to work, bearing in mind there were some mixed messages from the government, and that we quickly put in place social distancing measures to not only deliver confidence to our store teams, but to those customers who wish to continue shopping. Clearly that involved risk assessments and very clear guidelines, and a lot of communication, as I mentioned, with our store teams. The second phase was really to then understand which stores it was both operationally able to continue trading in terms of staff resource and also economically in terms of shopping patterns. And what was quite evident was that the customer was changing their shopping patterns and shopping very local to their homes, etc. Analysis of data enabled us to review our store portfolios, which subsequently led us to effectively close and furlough approximately 40% of our estate. Over this period, we also considered our ranges within stores, and the focus switched to those lines which were deemed as key categories, such as health and hygiene, whilst other key categories for Superdrug, such as fragrance and cosmetics, were suspended in terms of replenishment. So the whole focus was absolutely one of consumer confidence, store confidence, and focusing on the correct product lines that our customers wish to purchase. And then I'll start. Sorry,
I was going to say, and in the light of that, I mean, pro rata, because obviously it's not a like-for-like comparison, but how has trading in store held up during the period?
Needless to say, pre-COVID, we were experiencing strong like-for-like growth. Sales post-COVID and the announcement, our sales have significantly declined to double-digit like-for-like sales. So a significant reduction in like-for-like sales. And again, part of that, unsurprisingly, is social distancing. Clearly, taking that into account, we need to consider how many people are permitted into our stores, plus the reduced lines that we were replenishing into our stores. So a significant reduction in like-for-like sales.
You have a strong online presence which encompasses same-day delivery. I mean, has that conversely boomed during the period with a lot more delivery trading?
I think boom would be an exaggeration, and in comparison to other retailers such as Next, John Lewis, etc., online sales for Superdrug remain a relatively modest part of our income stream. However, it is true to say that online sales have increased and demand has increased. That has led in itself to its own challenges due to reduced capacities at our distribution centres. And again, we've had to change those platforms, so moving away from same-day delivery to delivery periods of in excess of 10 days. And in certain circumstances, we've had to reduce demand by reducing our web availability. But yes, we have experienced an increase on our online sales. But as I say, that revenue stream is relatively modest in compared to our store income stream.
And I'm getting a lot of questions on the Q&A button about the conversation with landlords, the hub of the matter. What's your experience been of how landlords have come to the party or otherwise?
Yes, I think it's fair to say there was a lot of coverage associated with our positions with negotiations with landlords. We continue negotiating with our landlords across all our store portfolios. I think challenging is a key word I would utilise in terms of those discussions, and I suspect those discussions will continue to remain challenging over the next 2 quarters. Superdrug did discharge their March quarter rent liabilities, and as has been advertised in the press, we will be adopting a reduced rental payment in June.
Okay. And I mean, obviously we have a not a normal shopping environment, even in the midst of reopening. What's your feeling about when we will get actually closer to normality, or is that a health issue and a wider societal issue than just one about retailing?
I think clearly it's more than just about retailing. Realistically, from a retail perspective, we do not expect our sale figures to return to pre-COVID levels until at least Q1, Q2 in 2021, and clearly it may be extended. There are certain measures that are clearly a focus of the government. Social distancing from 2 metres to 1 metre, I think, will play a very key role in delivering consumer confidence and making sure that the F&B industry can return to some form of new norm, which I think will also develop and deliver greater confidence in the shopping consumer.
And you mentioned to me the other day that you're a bit puzzled by some of the kind of prescriptive formulas about how many people can be in a store at any one time. How's that actually panning out? Because there seems to be a different approach depending on the setting of the store and indeed the landlord.
I think we within Superdrug we've taken a generic guidance, so we are limiting number of customers within stores to a key matrix. We hope that matrix will relax in the near future. I think it is ironic that we have completely shopping rules and regulations across England, Scotland and Wales, but notwithstanding those, we have got to work to best practice. Again, it's all about instilling confidence in our customers and the consumer. We will deliver all necessary measures, but I think the sooner we can adopt a 1 metre social distancing rule will be absolutely pivotal to the recovery of our retail industry.
That's great. Thank you, Nigel. I want to come back to you on turnover rents and the discussion period, but we'll park that just for the moment. We're going to turn now to London. We're going to look at the London market with Paul Souber, who is Colliers' head of London Retail Agency. And later on, we'll be hearing from Anthea Harries, who has oversight of Argent's retail and leisure portfolio at the King's Cross Central Development. But first, Paul, if I can come to you. London's always been something of a market apart in terms of UK retailing. It's huge international and local catchment have powered a unique collection of shopping environments. I mean, very early days, but how's it emerging from suspended animation, and has there been a resumption of occupier interest in store opportunities?
Afternoon, Duncan, and to everyone else who's joined us today. In answer to your question, I think there's been great anticipation over London reopening, and that's been widely reported since Monday. And obviously, it's hugely important to our economy. By way of background, retail spend in the capital is usually about 9 billion per annum. The retail and F&B sector employs 400,000 people. So it is absolutely vital to our recovery stage. I think picking up from points from Nigel's made, what we have to do immediately is we have to instill confidence. We have to make it clear that it's safe for consumers to shop, it's safe for workers to return, and it's safe for visitors to travel and visit London. And if we can do that, we can start getting London moving again and build reassurance, both in London and the UK, that it's safe to come here. And when that reassurance arrives, we'll then be in a position to welcome international visitors, which again is hugely important. In response to your question about inquiry levels, we conducted a number of transactions through lockdown, but since shops have reopened, there certainly are brands looking to take advantage of the opportunities that are presented. There are some amazing properties, and frankly on pretty amazing rebased deals that are out there, and a lot of brands are planning for the long term and a return to life.
And you mentioned there, obviously, the fundamental part that international visitor spend has played in the London market. I think estimates are sort of 50 or 60% of total shopping spend. In the absence of that returning, what can be done to encourage the domestic shopper to actually come into central London and shop and eat and drink, etc.?
Well, you're 100% right. In the last couple of years, London benefited from 20 million visitors, so it's hugely important to the market. And from my perspective, I can't see the international visitor returning in significant numbers until next year at the earliest. So what we have to do is we have to pivot, and we have to make sure London welcomes, as you point out, its domestic market. And I think what we need to do is make an occasion out of visiting London. So people, when they come, they go shopping, and on the 4th of July, they can go dining as well, make a full day out of it, a real treat. But in terms of sort of practical measures to sort of get people back in the stores, Colliers presented a 3-point plan to the government. And I'll just lay those points very briefly. We suggested that there should be an online sales levy, the proceeds of which are redistributed directly into the retail and F&B sectors, across the UK, not just London, in relation to London, that there should be free travel after 10 a.m. on public transport. And we felt that the Chancellor should allow VAT relief for in-store purchases. And I'm delighted to see that that measure seems to have been picked up and they may be running with it. Yeah.
Right. And the long-term prospects for London, I mean, is it resilient enough to weather the current storm, or will it never quite be what it was in its pomp?
Well, I think you would be absolutely crazy to bet against any major global city, and London in particular. It's incredibly resilient. And if you look at past pandemics and crises, you see that cities rebound, and invariably they come back stronger. There is, you might be surprised to hear this, but I think there's a potential Brexit bounce, would you believe? And we may be able to attract the European market post-Brexit by introducing tax-free shopping. So once we leave the bloc, there could be a really nice shot in the arm for the market. My sense is in the short to medium term, we'll move to localism, we'll support our local neighbourhoods, beg your pardon, and in the medium to long term, I absolutely bet on London to come back, as strong as it's been, if not stronger.
Thanks, Paul. It's interesting there on those direct action, which are obviously some themes to take forward. Now going to speak to Anthea Harries, who oversees the retail and leisure offer at King's Cross Central. Anthea, good afternoon.
Duncan, hi everybody.
Hi there. First of all, can you just give us a quick reminder about the extent of the retail and F&B estate at King's Cross? Because I guess a lot of people hear about the big office buildings and so on, but if you can just talk us through the top line of the retail and F&B.
Sure, absolutely. But it is a new destination for London. King's Cross is still only half complete. It will total 8 million square feet on 67 acres by 2024. With a fair wind. Obviously the construction activity has suffered as a consequence of this, but not too badly. The majority of the space, about 80%, is global occupiers who include Google, Facebook, Sony, Nike, Havas. But we have a really important ground floor. In the context of retail, I'll talk about it more generally, about 500,000 square feet. So small on a per square foot basis, but over 100 different retailers are currently in situ at the moment, and that will continue to grow as we build out the northern part of the estate. The main shopping areas are King's Boulevard, and obviously that's where Google are building their new London home, which will total over 750,000 square feet, with another 50,000 square feet at ground floor. And you've got retailers like Nike, Space NK, other stories on the main stretch into Granary Square, which everybody knows. And then Cold Drops is the newest addition to King's Cross, 100,000 square feet of retail, over 50 different stores, many of which are small independents, but anchored by Samsung, who have their showcase, their European showcase on the top floor there. And that PC'd and opened, gosh, now we're about 15 months ago, so still very much in its infancy, and is part of the overall scheme in terms of the development of the northern quarter of that site, which is under construction and will be home to Facebook, Nike and Sony when they arrive next year.
I mean, a tremendous range there from, as you say, the multinational brands to relatively small independents. So a great laboratory, I guess, in terms of what's happening at present in the market. And how did Argent respond once the lockdown came and closed everything down? I mean, I've heard it said that you've got a lot of kudos for the way that you engaged with occupiers. How did you go about that?
Well, I think it's been really interesting listening to Nigel speak today, because for us, time was of the essence for a change. And it was really, really important to give our occupiers comfort on how we, the partnership, were going to approach the March quarter's rent. So we took our rationale and our thought process to the board very, very quickly, and they were 100% supportive of ensuring that our retailers didn't have to pay rent for the March quarter. And our occupiers were really pleased with that. And I think it's testament to the fact that this is a larger estate of scale. These are new relationships. We've entered into a marriage effectively with these retailers very recently indeed. They had to close there and then. The office occupiers obviously left immediately. So the schools, university, CSM, UAL all shut down. And it would, in our view, have been unfair to have expected them to continue to pay their rent under their lease to us for that quarter when they just could not trade. And that was the first decision we made, but that was also important alongside some other initiatives that we immediately undertook, which was to support our occupiers online. So a big digital and social push on supporting their brands and how they are then selling their goods online. We also supported the F&B occupiers by relaxing some of the estate regulations around turnover, around takeaway and being able to trade through Deliveroo and the like. And in a normal situation, a lot of the leases do have restrictions around takeaway and delivery. So we try to take a very pragmatic, positive approach. We do believe with all our occupiers that a partnership approach to a long-term relationship is absolutely the right way forward, irrespective of the fact that we are currently in the middle of a pandemic.
And since Monday, 3 days in, what's the situation at King's Cross now in terms of who's open and who's still thinking about coming back?
Yeah, I mean, we've been in regular dialogue with those 100 occupiers. There's three different approaches, I suppose, to the way that we've tried to support and work with them. One is the digital and social support, which I've touched on previously. Physically, making sure that the estate is ready, feels open, feels welcoming, is safe, secure, clean. And we are privileged to be able to manage that on their behalf. And we have the support, again, of the partnership to make some pretty bold infrastructure changes to the public realm to enable people to access King's Cross through cycling, scooters, etc., hand sanitisation stations, temperature screening stations. All of that infrastructure is in very clear signage around social distancing and supporting retailers with the implementation of queuing systems, for example, Nike on the Boulevard. And when we hosted the retail forum, which was only actually a week ago now, it's probably fair to say that there was and is nervousness around consumer confidence, rightly so. And I think that phrase has come through absolutely today in terms of bringing people back to the estate. Obviously, the office occupiers in the main are still not there. And there's quite a broad range of focus for those occupiers on when they're going to return to King's Cross. Some are starting to return now, including ourselves. With the offices open, the schools are open, but also big occupiers like Google are taking a longer term approach to bringing their staff back to the office. So lots of physical changes on the public realm, supporting the retailers with their store openings, from queuing, giving them support on how to implement the COVID regulations, particularly the smaller retailers. And it's probably at the moment, it'll be interesting, I'll be there tomorrow, I think it will be about 20% of retail will be open. And I think the game changer here, as Paul's alluded to, will be hopefully, fingers crossed, the 4th of July, when a true mixed scheme like King's Cross, which is leisure, F&B, retail, cinemas, theatres, arts, events, it will really only truly come back to life once there is more diversity of choice for consumers and they feel more confident that they can make a day of it. And the toilets are open and all the facilities that you need to have an enjoyable day out. And I think it all rests on consumer confidence. But some of the bigger brands, as you would expect, are further down the track and have been preparing for longer. So for example, Nike have a app whereby you can book a slot at the store, so you're not standing in a 2-hour queue. And I think that's a really great initiative from them. And others are taking a more cautious approach. We have stores of only 500 square feet, so for them to manage their customer is really, really difficult. So early days, day 3, we feel, and I'm hopeful that they feel the same, that we've got the right level of infrastructure, we've got the right strategies and processes and procedures in place to support.
I mean, it certainly sounds like you've addressed the safety issue on the estate. I mean, picking up Paul's theme in terms of what other parties could do to stimulate shopping in London is, I mean, Paul's talked about transport, about financial support, VAT reductions. Is there anything else that you would add to that list?
Yeah, again, I think there's sort of 3 different tranches to that. There's the government support, some of which is still up in the air, but VAT I think would be a really positive step forward. Relaxation on trading hours, perhaps licensing. Obviously we've seen in the press today about Westminster relaxing outside seating and sales of F&B into the public realm, and we're privileged to be able to do that with Camden's support. But that's, again, I think going to be really important. We've got to allow the retailers to spread out of their stores onto the public realm to really entice that confidence, if they can do that, particularly in smaller streets. I'm looking at closing roads and pavements and free parking, free transport during shopping hours. I think it's incumbent on landlords as well. This is a partnership, whether you've got the ability to have the open public spaces or not. The landlords should be there to support the retailers and provide them with a partnership approach. And the June rent is, I'm sure, a question that will coming up now. And there's lots of guidance. The BPF have put out their guidance note, which obviously is with government. Some of us may have seen that, others not. But I think it's incumbent on the landlords to really understand this difficult period, appreciating we have our own liabilities and our own debts and our own costs to cover. And some landlords are smaller businesses than the retailers themselves. So we've got to bear that in mind. But it's important that we work together, and that is around management of the buildings or the stores, queues, digital social support, social distancing, signage and wayfinding, all of those things. If you can help the retailers, I think we should be doing it. And then finally, the retailers themselves, it must have been an exceptionally difficult time for them, but having a really clear strategy around how they're going to reopen those stores, being really organised, making sure that people can book slots. They've got a strong online platform to be able to support their in-store sales, looking at takeaway and delivery for the restaurateurs, having really slick delivery options, and really strong customer care around products, and really using this as a platform to explore other ways of engaging with their customer. So I think those 3 sort of aspects need to run in parallel with each other, but I don't think anyone's under any illusions that we're probably right at the eye of the storm right now in terms of looking forward to hopefully instilling consumer confidence and people coming back to shop.
That's great, thanks Anthea. So far we've been talking, I guess, predominantly from the leasing perspective and the occupier's view. We're now going to look at the actual demand for retail property investments. And joining me now is Tom Edson, Colliers Head of Retail Capital Markets, and shortly we'll also bring in James Boyd-Phillips from LaSalle Investment Management. But Tom, first of all, to start with you, the popular perception at the moment is that very little is going on in the commercial property investment sector, and particularly so in retail. Is that correct? And if there are retail assets selling, then what is in demand?
Good afternoon, everyone, and thank you, Duncan. We won't sugarcoat this. Commercial property is not in a good place at the moment. That is not just a retail-centric theme. It's just unfortunate over recent years, retail has certainly been the kicking horse. So it's certainly getting a lot more press, I think, than potentially some of the other areas. That said, in retail, yes, volumes are low. The bright spark at the moment, there's something with a degree of normality, is the supermarket or grocery sector. Obviously, their sales performance is pretty good at the moment. It will be interesting to see how that relates into profit at the end of the year, because of the vast costs they're having to spend to keep their stores open. But grocery so far is quite handy as we're approaching that kind of halfway point through the year. We think there is under offer or in solicitors' hands in excess of £600 million of deals. And if we look over the year average, it's about 1.3 billion, which we would normally see. And that's my daughter just coming through. Apologies about that. We are working from home. So yeah, the 10-year average is about 1.3 billion a year of food store investments done. Halfway point, we're at about 600 million. So that is on course at the moment, I would say, to hit the average. But that's the positive area. There is a little bit of activity in sites, certainly within London, that have an alternative use value, predominantly for residential. But that's not really a conventional investment. That is a development opportunity. So that market is still moving, but I'd say the demand is reducing. At the beginning of the year, we did see a bit of an uptick, I would say, in retail warehousing, but that promptly ground to a halt. But that is one area that, although at the moment there is very little stroke no activity, that is one of the first areas I'm beginning to sense a few more questions are coming from investors to look at that area. Part of the belief being that out-of-town retail warehousing are probably easier to implement social distancing measures. Shopping centres, unfortunately, are still not in a good place at all. Will certainly be the one with the biggest fear factor around. High streets, we've completed a couple of deals in lockdown, but I should emphasise they are discounted yields to what we would have seen 6 months and certainly 2 years ago, and they're also in very strong PMA kind of top 20 locations. So obviously investors are believing that those top locations should come back in due course.
And on that topic of yield shift, I mean, as a sort of a top line, you know, where yields across those main sectors have moved, what are we talking about? How many basis points?
Yeah, I don't want to upset my valuer colleague, but I mean, grocery is easy. We've got stability, and actually with grocery, we may see yield sharpen, ironically, as the year goes on. The other sectors, we are going to see movement out over the next few quarters. Inevitably, we're all interlinked. June quarter is going to be essential, and September as well. You'd anticipate 100 to 200 basis point movement out towards the year end to actually get transactions happen. Now, whether people are prepared to transact at these levels, we'll have to see. But that's quite a significant movement to current levels.
And in against that backdrop, I mean, you know, always whatever crisis we've been through, although this one is unique, we've always seen a spike of opportunistic buying. Who do you envisage being most active in that space? Will it be, you know, US private equity or sovereign wealth, or, you know, what's
you've part answered my question, Duncan. It's quite handy. Yeah, US equity. No, I'd say, I mean, wind back the clock 6 months. I'd say that there was actually a number of some being US equity funds building, I suppose, a war chest to step into the UK market. Quite a lot of that was focused around retail warehousing. Partly that was a play on sterling. They see it as kind of a deflated pound, so they could take advantage of that. That's obviously ground to a halt, but those kind of opportunistic buyers, and they're not all retail warehousing, I should say, they still have that capital, and that's the key here. They're already leveraged. So when they take confidence that there's a bit of normality coming back to the market, we'd anticipate that those are the sort of buyers that will come through. But the emphasis around them is they have to be leveraged. The debt market at the moment, with the exception of supermarket, is extremely challenging. So if you have an investor who's looking to deploy significant capital and requiring debt on a conventional retail parade or centre, then they are going to find it challenging. So those who have a very slick approval process, have cash and understand UK retail, and that it will recover and the best will still remain good, I would anticipate to be some of the earlier ones off the starting blocks.
Yeah, and on that theme of debt lending, dark clouds of recession, a couple of very challenging quarter days coming out. At what point do you expect lenders to start pulling the plug?
Yeah, a lot of press at the moment. Yeah, I think it would take a brave lender to probably pull the plug at the moment. As Anthea said, we're in the eye of the storm at the moment. So the last thing you need to do is to make it worse. Particularly, you also need to bear in mind that the borrower is likely to know the asset better than anybody else. Through circumstances not necessarily their own, they have they're not in a strong position. But going forward, the lender needs consistency in the management of that asset to get through this period. So changing a management team in whatever structure is probably not advisable at the moment. The question will come 2, 3, 4 quarters. This time next year, maybe we could see the shuffling of the pack. But you do need to keep in mind that the market is not awash with parties with appetite to take on lots of big assets. So it's not as clear cut as simply taking control of the asset and putting in a new lender. You also need to bear in mind that if a lender already had concerns on one of their assets, it's quite likely that was there prior to this crisis. So it wouldn't be a new theme should they decide to step in, regardless of the COVID situation.
Right. Thanks, Tom. We're now going to speak to James Boyd-Phillips from LaSalle Investment Management. Jimmy, good afternoon. Is he there?
Good afternoon. Good afternoon, Duncan. Good afternoon, everyone.
I've got to call him Jimmy. He says, or if I call him James, he thinks it's his mother calling. So, so Jimmy it is. Jimmy, you oversee the asset management of around £3 billion of retail property. What have been the main challenges since late March?
Oops, sorry, can I just had a little bit of instability there? I think it must be the storm that's going over.
Sorry, I was just saying you oversee £3 billion of retail assets. What have been the main challenges since the lockdown?
Well, I could relate going across. Certainly, the future between now and the sort of GFC, but the difference between today and then was we had to do all this and work remotely. Clearly, from the client's point of view, 90% of our business is pension funds and pensioners' money. We had to get the money in, and we were fortunate that for the last sort of 5 or 6 years we've been selling down a lot of retail, but clearly retail was the most affected sector in terms of rent collection. Even on our 3 billion, which is about sort of 25% of the business, we were hedged quite fortunately, and about a third of our portfolio is index-linked supermarkets. So that sort of helped, but really it was. They touched upon it again in the panel. It was the attrition in the shopping centres and trying to get the rent in on that. I think it. Overall on retail we were about sort of 68% within 7 days, but after but on shopping centres we were about 55% in the end. But some centres were certainly well below that initially, and it was just trying to get that in. I think now, obviously, clearly we're going through it. We've been trying to do all the the tenant re-gears, concession arrangements very early on, a bit like Anthea. We did a side of the business. We need to do something. We've always been. I would hope that if there were a panel of retailers there, they would be nodding their heads here. But we do generally try and work very closely with occupiers. We've spent a lot of time with all our clients. I think again, we're very different from say Anthea or say some of the REITs in that we've got 20 plus clients to deal with, and therefore it's a discussion not just the retailers, it's those clients. Different clients have different views. We've got 1,800 leases, so I can feel Nigel's pain, but we've got to do that across the client base and the retailers, and try and come up with a workable solution, and that's been quite difficult. And then obviously latterly, it's been on focusing on getting the schemes open and getting the heart pumping, and really hoping that we can pull ourselves out of this this sort of COVID close down, and try and recover some value for the clients.
And one of your roles at LaSalle is heading the retail repurposing team. Do you think the pandemic will accelerate that trend, or will it be compromised by the impact of social distancing on the most popular alternative, leisure and hotel uses most favoured by the repurposing process?
No, I think 100%. I think if one thing COVID has taught us, and you've only got to look at people like Primark for this, is that if you haven't got an online presence, then your business will suffer. And going forward, we're going to see a lot more CVAs and pre-packs, as Paul and Matt have sort of touched upon. But definitely, repurposing has become the buzzword, and the difficult thing is that very few schemes. I'll talk, say, shopping centres, retail warehousing. As Tom's alluded to, it's easy to price. You can price the dirt really quickly. If it's inside the M25, you've got a myriad of alternative uses, be it urban logistics, be it residential, be it other. With a shopping centre, it's really difficult. So actually trying to repurpose some of these assets is problematic. You've got fractured ownerships, you've got complicated tenure issues, you've got physical constraints to these buildings. COVID has made a lot more of this stuff obsolete. There will be towns, in the UK that will be absolutely closed down by this whole situation. A lot of retailers will not open in many places, and the contagion around that will be catastrophic for a lot of these towns, and it's going to be a real sad and shame. But I think right now, we need a wrecking ball, and we need government support to get that. There's too much retail in the country. Interestingly enough, I was on a call with my continental cousins earlier. For the first time, since the GFC, they're now talking about the impacts across their portfolios, and having the same conversations that we're having with retailers, and I've never heard that before. Yeah.
And just to sort of segue into the general discussion here, I've got so many people jumping up and down on the Q&A box saying, let's talk about turnover, let's talk about turnover rents. You mentioned you've got a lot of your portfolio is index linked. How do you feel as an asset manager about introducing a great, much greater proportion to a turnover basis?
I've been a big advocate for it, for a long time. As far as I'm concerned, the 54 Act is what's holding us back. If you've got assets in Scotland where you don't have protection, it's easier to have a proper grown-up conversation and get the deals done. In England, that holds us back. Certainly through this and through lease renewal process going through post-COVID, the retailers have used it as a whip hand. So to actually have a totally transparent, everyone talks about the factory outlet model. If you can get it right, from my point of view, it's the panacea. You so long as you have proper line of sight turnover, and you can share that, you can share the highs, you can share the lows. You've got flexibility around that and control. It's exact, and therefore you can proper partner. For 66 years we've sort of been the stick, as it were, and now we're getting a bit of our pain back. But I think that getting it back onto a level playing field is exactly where we need to get it, and I think turnover rents are certainly the solution.
And Nigel, can I bring you in on this turnover theme in terms of, extensive portfolios across the brands? What's the group attitude to turnover?
In terms of attitude to turnover, I think I can wholeheartedly endorse. I think this COVID-19 now offers a real opportunity to move forward. to review all leasing terms and make flexibility the key word, and turnover is just part of that discussion. I think it will be healthy to have a dialogue rather than base rents on historical evidence or nearly no evidence. I think it would be good to drive forward, and just as we've seen lease tenure fall from 20 years to 5 years to 3 years, I think it's just an evolution in the property market that we need to get to, and the sooner we can get there and absolutely deliver strong partnerships with landlords, the better, quite frankly. And I think it will also assist in the regeneration of high street shopping centres and retail destinations, because the weak will fail and the strong will thrive. And at the moment, we've got too many people being propped up through CVAs, etc., which we've already heard, the majority fail. And I think it is a great opportunity for regeneration. And if there's any positive statement coming out of a pandemic, is it will drive change, and we look forward to embracing that change.
And Tom, just from the point of view of the assets that are much more predominantly turnover approach would create, basically how do you value those, and would they be as popular in the market as good old set lease length, set rent, upward only reviews, blah blah blah?
There's always different buyers with investors with different requirements, but ultimately, I think it's fair to say we're coming from a low base for retail investment. So I completely agree with Nigel. It gives actually people the opportunity to rip the rule book up and go again. If an investor is looking to dispose of an asset, if it's illiquid, then an alternative option that may one day make it liquid surely has to be the correct approach to take. If the market was in a strong place and there was lots of demand for existing leases and listed structures, then obviously we wouldn't need to approach it, but it's not. So I think that there should be an approach to actually take it on board. The other thing in terms of the valuers, we mentioned it already, factory outlet centres, they're valued. The key around them is they've got a time period of turnover which they can analyse, and therefore you can effectively capitalise and calculate a value. Now, if you're starting from afresh on a town centre shopping centre, then you don't have the luxury of a time period of seeing what turnover the retailers actually generate. But as I said, going back to my earlier point, when you've got an asset which is a liquid, well, you need to go on the journey and go with it. And hopefully by taking these steps, you should have an asset which is more investor friendly in due course.
Excellent. And final point on this, Matt, obviously you were talking about data application, and it's not just about turnover. I guess that's something that needs to be made clear. It's about implementation of just different data sets. How does that get taken forward?
Yeah, it's great to have momentum behind this topic, but I suppose, as I alluded to in the presentation, I want to make clear that it's not just about turnover information, and for us, it's also, and particularly for landlords, it's about having a true understanding of who visits retail locations, how they engage with physical retail as well. And of course, having the right data in place is just one part of the puzzle as well. So the success of any new approach to leasing has to be underpinned by an understanding of how retailer business models operate. And we have our own proprietary set of models and perspectives that we use across this space to guide on affordability and how we value physical stores and their contribution online as well. So the next step for us has been to bring all this together into a new model for leasing, which we'll be sharing soon, along with a fresh survey to examine the attitudes towards a new approach as well.
I'm conscious that time is against us. I'm just going to put one question very quickly to all of our panelists. I think, Matt, you've had your turn, but everybody else, just a kind of what you would wish for in the future, the magic wand question. Nigel, if we can come to you first. We haven't even touched on business rates. We haven't touched on a lot of other metrics. What would you wish for?
I do think it's an opportunity to explore every avenue in terms of partnerships with landlords and tenants, and the critical focus is in terms of delivering what our consumers want for the 21st century. And I think those are the key dynamics. And if we focus on those attributes, then I think we will have a continued strong retail environment within the UK.
Anthea, what's your wished for item?
I think what's going to be important is transparency and openness between landlords and tenants to try and create a model that is genuinely a partnership. We know, for example, on the F&B side, it's much more transparent in terms of what operators are trading from specific stores. It's much more difficult on retail because we don't have full oversight of the online versus physical sales. And I think the holy grail will be when we can create a new approach to leasing that gives landlords and tenants a very clear clarity and a level playing field. And at the moment, that's quite disparate depending on who your landlord is, who your tenant is, and locationally as well. So, you know, coming out the back end of this pandemic, which has been incredibly difficult for everyone, both professionally and personally, it will be incumbent on us all to have very positive relationships and try and create a way forward that is meaningful.
Thanks, Anthea. Tom?
I think school's open this afternoon would have been nice. I'm just going to repeat what the others said. I think just a sustained occupational model is what I'd like to see. If we've got happy retailers, we've got happy landlords, happy investors, and we've got a market.
Okay. Jimmy?
Yeah, I think it's been said, but I think, you know, trust. I think that's the most important thing, because what a retailer says is their turnover and what, you know, and what we get are two different things often enough, and therefore, you know, we've just got to rip up the rule book and start afresh. Whether it means we have line of sight sales, you know, we've got to accept that these assets now are running a business. You know, it's not about real estate anymore. If you run a shopping centre, you're running a business, and you've got to think about it that way, and you wouldn't partner with anyone else other than a true and above board way. So yeah, trust.
Okay. Dan?
Yeah, I've frequently been a critic of government, both in terms of this administration and previous administrations, that they don't fundamentally value or really understand the giant ecosystem that is retail, and also the retail property industry that supports it. I'd love them to reflect on the fact that we've got 10% of the workforce work in retail. There's £400 billion worth of sales, 5% of GDP, you know, 100 times the employment of the steel industry, and all of these incredible facts that show you just how gigantic and meaningful this industry is. And from the landlord side, the fact that it looks after a lot of the income for us and pension holders all over the UK. And I hope that this crisis and what they've seen in terms of shopping and the absence of shopping will mean that they will fundamentally value and properly support our industry going forward in a coordinated, comprehensive way.
Thanks, Dan. And as usual, Mr. Souber, you get the last word.
Fabulous. Well, it's all been said, but the one thing that springs to my mind would be a vaccine. Would be, you know, a great thing to have, and the confidence levels that would come as a result of that. Or if we have herd immunity, I would think we would see a huge bounce on the back of that. And on a personal level, I'd love a haircut.
God knows you need one. I'm very sorry we've kind of run out of road. I'm sorry we haven't been able to get to a lot of your questions. Hopefully we can come back to you offline on some of those because we've got them here. I hope you've enjoyed the session. I think the panelists have been superb and to the point, which is what anybody in my position always hopes for. We'll be emailing everybody access to a replay of today's webinar. And you can also follow Colliers on social media for news and views across all the property sectors. But for the present, thank you very much for your attention. Thank you to the panel and good afternoon.